Welcome to Accountable, where your business is our business. Hosted by David R. Peters.
Hi, everyone. Welcome to Accountable, the podcast for CFOs by a CFO. Hey, my name's Dave. Thank you so much for joining us this week on Accountable. So one of the things that I get asked about a lot is some of the considerations when it comes to starting a business. For those of you that have been following the podcast for a while, one of the things that you probably know is that the bulk of my career, I have been in startup businesses. So one of the first jobs that I had, I was a part of a startup business, Elephant Auto Insurance, which is a 6-state auto insurance carrier in Richmond, Virginia. And I was employee number 50 there. So very early on in the startup phase for them. And then I was also the very first CFO of Compare.com, which is a price comparison website for auto insurance rates, very similar in concept to Kayak for auto insurance. So that was another of another thing that I was involved in the past. And a lot of you know that now I am out on my own and that I'm working with as a financial advisor for clients and doing some tax preparation and things like that as well. And so my background is in startups. A lot of my clients are startup entities as well. And so, a lot of times, I field questions around kind of how to get started with a new business. So I do a lot of presentations on new businesses and things like that as well. And so, that's something that I spend a lot of time talking about with people so they know that this is an area of interest. Those of you that have been on the petersprofessionaleducation.com website, you also know that we are coming out with a new series called Going Out on Your Own, where we are teaching kind of formal classes on some of these things around starting a new business and things like that. So this is definitely an area of passion for me. Plus, I think that, kind of coming out of the pandemic, I think that people are starting anyway to feel comfortable with some of the things that are going on. Obviously, we are dealing with inflation and some other issues as well. But I think a lot of folks are starting to feel like they kind of have their feet back under them again, and they're starting to think about new ideas. The future looks a lot brighter than maybe it did for a lot of folks, a year ago or 2 years ago. And even though we still have a lot of issues in our economy right now, they're starting to think about kind of what the next step is. And so some people are considering going out on their own. So today, what we wanted to do here on Accountable was talk a little bit about some of the considerations that one might be thinking about when it comes to starting a new business. Now, this is one of those podcasts that I think that could probably go on for several weeks. This is just a very big topic. It's a very, it's got a lot of pieces to it and a lot of aspects to it. So what we're going to do today is we're going to hit on some things that I think that I get questioned about the most. And my hope is that this is going to be helpful to you. Now, there's a lot of content out there about starting a new business. I think that that is, fair to say. There is a lot of things on the internet, and also there's a lot of classes, and there's a lot of organizations kind of dedicated to startup entities and things like that. But a lot of times, I think what I see with a lot of clients, and what I hear from a lot of clients, and what I've even experienced in my own business life, is that in a lot of cases they are aiming their product, they're aiming that content towards people that are in a different position from the position that my clients and me at various points in my life have actually been in. A lot of times they are aiming their content towards people who have investors, people who are coming at the new business and the startup with lots of capital, with lots of, things, lots of resources that a lot of my clients, a lot of times they really don't have. And, I can tell you that when I started out on my own as a tax practitioner, I didn't have a lot of capital, and it wasn't like I necessarily had a lot of investors either. I mean, the money that I had was coming out of my own pocket. And so as a result, I ended up kind of working through a lot of things on my own. And so that is, I think, kind of a challenge and a market need that really hasn't been, maybe discussed as much as maybe it should be. And so our goal here today is not necessarily to give you everything that you could ever need to start up a business, but certainly we're going to try here to cover at least a few of the major questions that I get asked about a lot. So with that in mind, let's jump in here and just kind of talk about some of the things that new business owners, especially if it's, your money and it's just you who's basically kind of funding this business. What are some things that you kind of need to do to get your feet under you? And so the first thing that I think that we need to talk about is state registration. So a lot of times what you will need to do kind of first and foremost, kind of straight out of the gate, is you're going to need to form a business with the Secretary of State. Now, there are some states that require you to file your state registration with another entity, but in most states, you're going to be filing with the Secretary of State, and you are going to file a state registration basically in every place where you are doing business. And sometimes this is going to require you to employ the services of an attorney. And, so just to be clear here, I am not an attorney. I don't give legal advice, and this isn't intended to be legal advice here. All I'm saying is that, when you are first starting a business, it's important to make sure that you are legally formed correctly. And so a lot of times what that is going to entail is it's going to entail you filing some papers with the Secretary of State and typically paying a fee as a part of that. Now, what papers you need to file, that is going to depend typically on the entity that you are trying to form. So when we have corporations, typically they're going to need to file in the articles of incorporation with the Secretary of State. LLCs generally have different papers than corporations have. And so it's going to depend on what exactly, what entity you are starting and how you are forming, and just kind of what state you're in. And that's where an attorney can help. So that is something that, a lot of times if you are going to employ some help to try to figure out kind of where you need to file and kind of what you need to file, that's where an attorney can definitely help you out. A lot of times, a lot of CPAs are not able to fill out state registration paperwork. And the reason for that is that that is considered practicing in the field of law. And so unless you're licensed to practice law, a lot of times CPAs can't do that. Now, clients can do it for themselves typically. So, whether or not that's a good idea for you, I think it depends on your background and kind of where you're comfortable and where you're not. All of us come from different backgrounds. There's certain things that you probably feel very comfortable with when you're starting a new business. And then there's probably some other things where you are feeling far less comfortable. And so if this is a place where you are comfortable in a lot of states, you can do this yourself. However, if you're not feeling comfortable, that again is where an attorney can probably help you out. Now, where do you actually need to file a state registration? It's going to depend on state law. And a lot of times, the deal is that you're going to file a state registration in any state where you are doing business. And that's where it gets complicated, because what constitutes doing business in one state doesn't necessarily constitute doing business in another state. And so, I've had clients that have said, okay, well, what happens if I have just a warehouse that I have across state lines? Does that mean that I have to file as state registration with that state, even though that warehouse is not in my residence state? Maybe it's just kind of right over the border or something like that. Well, that's going to depend on individual state law. And so that's where it gets kind of complicated. And so that is the part where, again, if you are working over state lines, that is where things can kind of get complicated. Now, if you are located in one particular state and, you're kind of all of your clients are in that particular state and you have a relatively simple situation where you're just kind of selling locally, well, at that point, certainly we need to file a state registration in our own state, in our state of residence. But whether or not you need to file a state registration in another state, that is going to depend on state law. And again, a lot of times it's going to depend on where exactly are you doing business and what constitutes doing business in that particular state. So the resident state is pretty much a given. We generally are going to need to file a state registration in that state. If you're not sure on that, again, check with an attorney. But, most of the time that's going to be the way. With the non-resident states, that's where things get complicated. And again, that is where we're going to look to state statute to figure out whether or not we need to register. If we are doing business in a particular state, if we're holding ourselves out in a particular state, a lot of times that is considered to be doing business. One of the things that can also come into play is that if you are in a professional services type of industry, or if you are maybe required to register with a state based off of kind of what you're doing. For example, the insurance industry, a lot of times will say that, even though the insurance part of the state code kind of sits in a different spot than the business kind of main business part of the state law, a lot of times what you're going to have to do is you're still going to have to file with the Secretary of State. So you're going to have to file with the Secretary of State. Otherwise, you can't get an insurance license. So sometimes that can come into play too, where you may need to register with the state if you need to get a license in a particular area as well. Now, one of the things that comes up periodically is people will say, well, I heard, a lot of times that's how it comes to me, is they say, well, I heard that, as a sole proprietor that I don't need to register with a particular state. And that can be true. Sometimes when it comes to sole proprietorships, a lot of times registration is not required because the way that the state looks at that, they look at that as kind of being you, right? So if I'm a sole proprietor, there's no kind of separate taxable entity necessarily. And so therefore, we kind of look at that as kind of being one and the same. It's you. However, there are some exceptions to that. And that's the part where we got to be a little bit careful. For example, CPAs, a lot of times they still have to be registered at least with the Board of Accountancy, even if they have a sole proprietorship, if they are servicing clients in a particular state. So that is one to watch out for, is that there are certain industries where you may still need to register something, even if you're a sole proprietorship. And again, I point to CPAs because that is the one that I am certainly most familiar with, is that, even if you're organized as a sole proprietorship, that is one that is where we're still going to have to register with at least the Board of Accountancy, if not the Secretary of State. So just something to just keep in mind there. Now, once we have our registration complete, and there are typically some rules around kind of what name we can pick when it comes to a particular state. And so sometimes what we may end up doing is that we may have a name that we form as in a particular state because that is going to be following the rules. So, as just some common examples, if you're formed as an LLC in a particular state, a lot of times you have to have LLC in your state name. So, so that may be the case there. Also, if you are doing business in a particular industry, sometimes the business that you are doing has to be somewhere in the name that you pick. So, for example, if you are working in the insurance industry, as one example, you may have to have the word insurance in your name. So you may not be able to say, David Peters LLC. LLC, you might have to say David Peters Insurance LLC as an example, something like that. Once you have complied with the statutes and your state registration has become approved, you may say, you know what, the legal name that we formed under, that's a little clunky. It's a name that we needed to do. It's something that we needed to do just to get kind of up and going. However, we may not necessarily look at that as being like, yeah, that's the name that we want to hold ourselves out to the public as. So when that happens, you may end up picking what is referred to commonly as a doing business as, a DBA, a trade name, or a fictitious name. So they go by different terminology depending on the state that you're in. But in a lot of cases, what we see with trade names and fictitious names is that is the name that you want to market yourself as. And so there's a difference between, kind of what the legal name of an entity is versus what exactly we want to hold ourselves out as when we're marketing. And so sometimes what we need to do is we want to pick a trade name, a fictitious name, a DBA, in order for us to be able to hold ourselves out in the way that we want to. Now, there's going to be rules around what names we can use. And one of the ones that, tends to come up in a lot of state codes is that you can't be substantially similar. So there is this idea that we don't want to be confusing to the public. And so as a result, that makes it so that, I can't pick a name of a company that's already out there. And so, if it's a well-known name and people kind of associate that name with a particular company, I can't pick it too. And so that is basically what that's all about. You can't be confusingly, substantially similar to another name that is already on the market that people know, because then, consumers can get confused. So a lot of times you have to have trade names. They have to be approved by someone in a particular state, or sometimes even the county. So sometimes with trade names, you may have to file in a particular county. You may have to file that DBA in a particular county. In other places, you have to file it with the state. So it could be either one, depending on where you're at in the country. So sometimes you need to file county by county. Sometimes you need to file with a particular state. Now, one of the things to keep in mind is that if you have decided that a trade name is something that you gotta have, then something to think about is that just because I have a trade name in my county or my state, that doesn't necessarily mean I can just sort of automatically use that name in another state, because somebody may have that. So for example, for me, I have a pretty common name, David Peters. If your name is something common as well, Bill Smith or whatever, that may be something where somebody may already have that trade name. They may have that doing business as name in another state already, and so as a result, you may not be able to use it. And so when we are thinking about trade names, especially if you are thinking about expanding across state lines, that's where we need to be careful, and we need to make sure that it's going to be a trade name that we're going to be able to file in a bunch of different places. So, if that's the name that we want and that's what we want to market ourselves as, we got to make sure that that we're able to do that. Now, one of the things that you can do, it is business and it is, real life here. You can reach out to somebody who already has a DBA in a particular state, in a particular area, and you can obviously offer to buy it, so sometimes that can be the way to go if you really need a particular trade name. So I've been through that in the past with other businesses that I have worked with, and that is something that can be done. Be careful with doing that, though, especially if you are trying to obtain intellectual rights to something. If you're trying to obtain rights to a particular name, then then we want to be careful on that. And certainly that is some papers where we want to get an intellectual property attorney or someone or an attorney that kind of specializes in, kind of trade names and business law, and that can help you kind of guide you along in that process, because that is where that starts to get confusing. So, if they sell that name to you, you want to be able to market that name, and you don't want them to be able to kind of interfere with what you are trying to do. So that is something where we need to get an attorney involved in order to make sure that we have our rights in the contract itself. So DBAs can be a great thing. Certainly they can be great for branding, for marketing, things like that. But again, typically you're going to have to file a DBA in a particular state or a particular county. That can also start to add up in terms of cost as well. So that's another piece to kind of look out for. Other things that we need to take care of: registering for unemployment. So if you do happen to have employees, or if you're looking to gather employees over time because you're looking to grow, certainly we need to register for unemployment. So we need to register in the unemployment office. And, so a lot of times we're going to need to register for unemployment in the states where our employees are most likely to look for work. A lot of times that's going to be the case where we are going to where we're going to register for unemployment. We're typically going to register in the places where our employees are going to look for work should they become unemployed. So that's just kind of a general rule of thumb. Now, let's go a little bit beyond that, because I want to be careful here. Each state has rules about who needs to register for unemployment. Okay, so again, that's another thing that is going to vary from one state to the next. But I'm just saying, as kind of a general guide, if you're sitting there thinking to yourself, okay, where all do I need to register for unemployment? A lot of times it is worth looking at the state codes in the state where the employee is most likely to look for work to figure out whether or not you need to register for unemployment in that particular state. So that's an important piece to keep in mind. Look at the state codes in the places where, if the person becomes unemployed, where they're going to look for work. That's a good kind of rule of thumb as a place to start. And then let the state codes kind of guide you along in terms of where you need to actually register. So that's an important consideration, I think, especially if you live in an area where you are right next to the border. So in my past, I have done work for companies that have been in the DC area where it's kind of right next to the Maryland state line, also right next to the Virginia state line. In the Carolinas and the Charlotte area, Charlotte is only a few miles from the South Carolina border, so not unusual to have employees that are working across state lines, and that's where you got to be careful. Like Kansas City is another one that comes to mind, but you get the idea. If you're near state lines, that's a good one to kind of check out as you're going along. The other one is payroll. So, when it comes to employees, this is something that, especially if you're kind of funding a business out of your own pocket, one of the things that we want to think about is whether or not we want employees. I can tell you that administratively, it's a whole lot easier if you don't have employees. So, when it comes right down to it, the fact is that, we can form a sole proprietorship, and we don't necessarily have to really file much outside of a Schedule C on our tax forms, and generally we don't have to do a lot. We may have to get a business license. That's entirely possible, and we may have to register depending on kind of what business we're in with the Secretary of State, as we kind of already talked about. But in general, we typically don't have to do a lot. And so, so that's something that we need to consider as well. If you're okay with, just kind of working out on your own and running your business where it's just you, then that can be maybe something to look at. Now, if you're going to expand, of course, you're going to need employees, right? We can all only do so much. I've been told in my past that if the day was 30 hours long, that I would just work another 6 hours in a day. So I've been told that in my past. Some of you may have been told that as well. I think that on some level kind of goes along with just being an entrepreneur. I think, a lot of us, we love what we do, and so we spend a lot of time doing doing it. And so, that is, but, we all have limits. We all have, time limits and how much time we want to put in on stuff. And so, if you are in a situation where you are looking to expand, you're looking to grow, well, then you're going to need to have employees. And there really isn't another way around that. And so when we have employees, we have to worry about unemployment. We also need to worry about registering for payroll taxes with the state taxing authority, as well as with the IRS. And so when it comes to payroll tax reports, typically what we see is that we need to, at the very least, file a Form 941. 941 is a payroll tax return. That's a federal payroll tax return. So generally, that is where we are going to report our federal withholding that we've had from employees, FICA and Medicare. All of those things are generally going to be shown on Form 941. Your federal unemployment taxes, your FUTA taxes, those are going to be shown generally on Form 940. That's at the federal level. Now, in my experience, the federal stuff tends to be the stuff that, a lot of business owners feel pretty good about. The part that throws them in a lot of cases is the state stuff. And so the state stuff can be something that I think is maybe a little bit confusing. A lot of states, you need to file what is referred to as kind of a withholding report or a wage report. That's pretty common across states, where what you are going to have to do is you're going to have to tell the state how much you paid out in wages to employees in their particular state. And so that is typically done on what is normally referred to as a withholding report, or sometimes a wage report. They go by different names, but it's kind of a similar idea, where we're just basically showing the compensation that we paid to a particular employee in a particular state. So that's pretty common. Watch out for that state level stuff. That is where, if you are looking to outsource that, if that is maybe not a spot that you are comfortable, that's where a good payroll service can help you out. Or if you don't want to use a payroll service, also there are some CPAs that are definitely kind of specialists in that area. So that can be a way to go as well. So some of your CPA firms kind of specialize in payroll taxes. Also, there are some large payroll services that are out there as well that can also probably help out with that. And, they specialize in that. One thing, though, to watch out for, again, is just making sure that as soon as we start paying employees, we need to start looking at the state level, because a lot of times the grace period for sort of getting those things in place at the state level is not very long. Typically, once we start paying employees in a particular state, we're on the hook for making filings. And we got to make sure that we are set up and able to make those filings right away. A lot of times you will have an ID number or something like that is given out by the state so that you can file those returns. And so they want to make sure that you're putting that ID on every single payroll tax return that you're sending them. And so that's going to require a registration process. So you're going to have to go out, you're going to have to register with the state, and then you're going to have to start making your filings. And so sometimes that registration process can be really quick, like maybe it's online or something like that. Other states, maybe it's not so quick, and maybe there's a time period that they take to review applications and just make sure everything gets processed. So that's another thing to watch out for. A lot of my newer clients, that's typically something that I recommend jumping on pretty quick, because the longer you let it go, the more there is a chance that you're going to miss a filing. And a lot of times that can be pretty costly early on when it comes to just kind of getting established. And a lot of times, with new businesses, I don't think that I'm necessarily out of bounds on this. A lot of times, with new businesses, cash flow is tight. We got enough things going on. We got enough things to worry about. Whether or not, our state payroll filings are correct. Hopefully that's just something that we need to get going and get taken care of kind of right away before we get kind of too far down the road. Because if we get too far down the road, it's going to be tough to get back because again, those penalties and those misfilings, can add up really quickly. So, just make sure that you're kind of on top of that. One of the other ones that does tend to get missed a lot of times with new businesses is personal property taxes. So a lot of times with a new business, there's typically a personal property tax based on where you are actually holding your personal property. So so if your personal property happens to be in Henrico County in Virginia, then you're going to need to file a personal property tax return there with the county, with Henrico County, making sure that you are declaring all of your business property to the county, and they're going to assess a tax against that. And typically, there is going to be a return that is going to be required, and then they're going to send you a bill later. That's pretty normal in most states. One of the things to look out for, and I just point this out because a lot of you are CPA practitioners and you're working in a particular industry. One of the things to look out for is that your personal property taxes in a lot of states are going to be due in the first quarter. And so the first quarter tends to be pretty busy for a lot of us, right? I mean, we come off after holiday time, and if you are working in an industry where you have a 12/31 year end, you're pretty busy. January, February, March. I mean, those are your prime times. If you're a tax practitioner, that is prime time for you. If you're an auditor, that's prime time for you. And so, so we tend to have a lot of things going on. And the reason why I mention that is that this is one that, have had clients miss in the past. And it's just because, they were busy. They were trying to get the year end stuff done. And, and a lot of times, after people come back from the holidays, they're kind of, rip roaring, ready to go. And so, so they got a lot of stuff going on, and they got people asking them for stuff, and they got clients asking them for stuff. And this just happens to get missed. And so this is one to just kind of get on top of, right away. A lot of times personal property taxes are often due in the first quarter of the year. And that is one certainly that we want to make sure that we're on top of, and one that we are able to just be able to be on top of and kind of cross off of our list kind of first and foremost. Another one that oftentimes tends to get missed when folks go out on their own for the very first time is estimated taxes. And so estimated taxes are one that I think are in a lot of cases, at least for a lot of the clients that I've worked with in the past, they're going out on their own for the first time, typically after working for another company. So when I'm working for another company, one of the things that I have the advantage of is W-2s. So I have typically a payroll department or someone in payroll. Sometimes it's a controller or something like that is taking care of the company's payroll. And so as a part of that, I have withholding. Well, if I go out on my own, I don't have withholding anymore. And so a lot of times that is one where, especially in the first year of business, I've had a few clients that have kind of learned the hard way where, they were kind of used to having somebody else kind of take care of their withholding. And then they go out on their own and they realize that nobody's doing this. And so they realize that they were supposed to be responsible for paying estimated taxes, and they weren't doing it. So withholding and estimated taxes are kind of 6 of one, half dozen of the other in the state taxing agency's eyes and in the IRS's eyes. So the rules is that basically we are going to make quarterly payments to both the Fed and the state. If you're living in a state that has a state income tax, typically estimated payments are going to be due quarterly. Most of the time, they are going to be due at the same time as the federal payments, but there are some states that are exceptions to that, and so typically at the federal level, estimated payments are going to be due April 15th, June 15th, September 15th, and then again on January 15th of the next year. So that's going to be your that's going to be your 4 quarters. So first quarter is typically going to be due on April 15th, and that is going to be true at the federal level. So at the federal level, it's April 15th, June 15th, September 15th, and January 15th. On the state level, the dates can vary a little bit, but a lot of states just tend to follow the federal due dates simply because that makes things a little bit easier for everybody involved. But that is not always the case, so be a little bit careful. For example, in the Commonwealth of Virginia, we actually have a difference in the filing date where taxes are due and when our estimated payments are due, especially in that first quarter of the year. And so that can happen if you live in one of those states. So just be careful on that. But in general, 4/15, 6/15, 9/15, and 1/15, that is when your federal tax payments are going to be due. Your estimated tax payments are going to be due. Now, how much do we need to actually pay in terms of estimated tax payments? So that's a question I get a lot. And the rule is that at the federal level, I should be clear on this, at the federal level, you got to pay in at least 90% of your current year taxes or 100% of last year's taxes, whatever your taxes were that you had, your total taxes, not your balance due. So sometimes I have people that say, well, I owed, $500 last year. No. Okay. We mean your total taxes. Okay. So your total tax liability on the previous year's return, 100% of that, unless you have adjusted gross income of $150,000 or more. If you have adjusted gross income of $150,000 or more, it's actually 110% of last year or 90% of the current year. So if you're below that threshold, 100% of last year, 90% of the current year. If you're above that threshold, 110% of last year or 90% of the current year. Whichever is lower, that is how much that you need to pay in. By doing that, that doesn't mean that you're not going to owe taxes come April 15th. That's not the case. What it does mean, however, is that you are going to avoid an underpayment of estimated tax penalty, okay? So you pay in estimated taxes in order to avoid a penalty. Let's be clear on that. I've had a lot of people that have sort of mistaken, I think, what we're saying when we talk about how much to pay for estimated taxes. It is not that you're not going to have to square up at the end of the tax year when we pay in estimated tax payments. So let's be clear on that. You're still going to have to square up. I think that the best way to think about a tax return is to think about it as kind of a squaring up or a reconciliation of what is going on in your tax world that you send to the government every single year. That's the best way to think about it. I've had a few clients that have said to me, they've said, well, Dave, I only pay taxes at the end of the year. No, you don't. You don't pay taxes just one time a year. You pay taxes throughout the year, whether that's through withholding or it is through estimated tax payments. Either way, you pay taxes throughout the year. What you do at the end of the year is you actually file a tax return that is a reconciliation. It's a square up of everything that you have done in your tax world during the year. And then we figure out kind of who owes what. It's sort of like, if you ever have some friends where, you go out one time and, they pay for lunch and then we go out the next time and you pay for lunch and then, we kind of square up at some point. We say, okay, you paid the last 2 times. I paid, the 3 times before that. And so therefore you owe me this time, so it's kind of a similar concept. I mean, you're basically going through and you're reconciling, you're trying to sort of square up everything that happened in your tax world. That's really what the tax return is. So paying in estimated taxes is going to help you to avoid an estimated tax penalty for underpayment. So if you don't pay in enough estimated taxes or withholding throughout the year, or some combination of both. So I sometimes get that question too. Well, people say, well, how much do I need to pay in withholding and how much do I need to pay in estimated taxes? Well, it's 6 of one, half dozen of the other to the state taxing agency or the federal taxing agency. So it's estimated taxes or withholding or some combination of both. By meeting the thresholds that I just mentioned, 90% of the current year or 100% of last year or 110% of last year, depending on your AGI, that is ultimately what is going to dictate whether or not you have a penalty for underpayment of taxes. Now, we should mention, we would be remiss if we did not mention that states can be different. Okay. So states typically have similar rules to the Fed, but they don't always have the same rules. So be a little bit careful. Sometimes what can happen is that let's say that you are new in a particular state. You may not be able to use 100% of last year because, if last year you didn't file a return, they don't just say, okay, don't worry about estimated taxes for this year. That may not be the case. So we need to be a little bit careful at the state level to make sure that we don't miss those estimated tax payments. Sometimes some states you need to pay in right away. We need to start making estimated tax payments the first quarter that you are actually doing business in that particular state. So be careful on that one. That does tend to happen every now and again. So be careful about your estimated tax payments. That's another place where I think a lot of people just kind of get started bad. They didn't realize that they owed something. They didn't realize that they were supposed to get started doing estimated taxes. And so therefore they don't do anything. And so they forget that to make those payments. And then they end up with a sizable penalty at the end and typically some interest too. So get started well. I mean, that's really the big thing and kind of the big message, I guess, probably throughout this podcast is just kind of how do you get started well? What do you do? And so hopefully that's what we're the way that we're trying to address this today. That's the thing that we're trying to attack. And we just want to make sure that we're getting people started off on the good foot. Nothing can kill an idea faster than getting into insurance issues where basically, if you have an accident and we're not covered for an accident, that can kill an idea really fast. The other thing that can kill an idea really fast is getting in trouble with the regulatory agencies. Make sure that you're registered with the taxing agencies and stuff like that. As long as you do that kind of straight off, I think that you can usually get off to a good start. We want to give your business a chance to grow. I mean, that's the whole point of doing this. I mean, you go out into business on your own. We want to give it a chance to grow. And that's really what we're trying to get across here today. Okay, let's talk about some other things that oftentimes, I get questions about. One of the other things that has come into play here more recently is this idea of nexus. And what nexus is a legal term that basically says, okay, how much of a connection do I have to have with a particular state before that state is allowed to tax me? So if I have nexus with a particular state, that means that my connection with that state is enough where they have the ability to tax me. And even if I don't have any income in that state, nexus oftentimes will mean that I need to file a return in that particular state. That's another piece of this that is important here. So when it comes to sales tax nexus, in other words, nexus that is required from a particular state before that state is allowed to charge a sales tax is generally going to be based on, historically, it's always been based on where you are physically located. So that was the case for a very long time until more recently, where we had a court case called Wayfair. Wayfair basically said that now we have sort of an economic presence standard for each state for the most part. Okay, so there's still some states out there that don't charge a sales tax. So obviously the Wayfair case didn't change that in a lot of instances. So, but for a lot of states that do have a sales tax, oftentimes what they have now is what we refer to as economic nexus, which is basically says that according to a lot of state statutes, where it's going to be like if I have over a certain number of transactions or I have over a certain amount of sales in a particular state, that I am going to have nexus. I'm going to have sales tax nexus with that particular state. That means that I'm going to have to file sales tax returns. It also means that I'm going to have to probably file in addition to the sales tax return, I'm actually going to have to pay the sales tax in that particular state based off of whatever sales tax they happen to charge. So that has historically been the way. It's always been physical presence. So in other words, if I was physically located in a state, I have to pay sales tax there. These days, a lot of of times it is based off of an economic presence standard. If you want to get into some of the details around that, take a look in the archives. I recently did a podcast about multi-state taxation with a CPA that is in the California area, and so she goes into great detail about just kind of everything kind of going on in the Nexus world when it comes to dealing with multiple states, because it does get really confusing because you have lots of different codes that come into play there. Now, not every state has the same threshold in terms of the number of transactions that you need to have or the number of dollars that you need to have in a particular state before you have Nexus. So it's not consistent across the board. After Wayfair, we did see that there was some consistency out there, but even with that, it's not true across the board. So some states, as an example, they may only have a dollar threshold. So, so once you meet that dollar threshold, we don't care about the number of transactions. We care about the number of dollars. So that is one example of where that would be a deviation from what I just talked about. So be careful on that. But in general, sales tax nexus is based on the number of transactions that you have in a particular state. In other words, how many times am I selling to people that are in a particular state? And then in other instances, it's going to be based on how many dollars of sales have I had in a particular state, or in a lot of cases, it's going to be some combination of both. So if I jump over 200 transactions or I jump over $100,000, then I have Nexus. That is, that is pretty common when it comes to sales tax Nexus. Now, on the income tax side, normally it's you're going to incur an income tax liability when we have sales and we have net income, when we have taxable income in a particular state. For service-based businesses, a lot of times income tax nexus is going to be based on where exactly the services were performed. So, so if I am a contractor and I'm moving across state lines to go and service, something, to go, build something for someone in a particular state, that is going to be where that sale is going to be sourced. It's going to be sourced to that particular state, and I am going to incur income taxes there because I'm doing services in that particular state. With property, it depends on, if I'm selling instead of selling services, maybe I'm selling, goods. In that instance, is a little bit more tricky because historically we've always used an equal weighted factor model. Historically, a lot of times we've used the Massachusetts 3-factor model, which is based off of 1/3 is going to be based on where the sales are, so where the customer is. The second factor is going to be based on where your payroll is, and the third factor is going to be based on where your property is. That is becoming less and less the case. A lot of states have gone away from a 3-factor model when it comes to income taxes. A lot of times these days, we are looking at where the sales are. So there's been a heavier influence on where the sales are, a heavier weight that's given to where the sales are. And so some states have said, okay, let's double that sales factor. Or some states have just said, you know what, we don't care about where your property and where your payroll is. We care more about where the sales are going. So who is the customer that you're ultimately servicing? That is going to be where you're going to pay income taxes. So that's becoming more and more the case. I think, and the reasoning for that, I think, is relatively simple. I mean, it used to be that, the United States was a lot more of manufacturing businesses. And so when we have a manufacturing business, it matters where your people are. It matters where your property is. So it matters where your payroll is. It matters where your property is. And so it kind of makes sense that when we're figuring out where your income taxes should be paid, that those two factors should come into play. In the internet world, we are finding, especially after the pandemic, that we can sell things to people where we don't have any people and we don't have any property. We don't have any, property, plant, and equipment. And so therefore, it kind of makes sense that a lot of states are kind of saying, where your property is really doesn't matter a whole lot anymore. Where your people are, maybe that doesn't matter anymore either. And so a lot of times, a lot of states are just going to what is typically referred to as a single sales factor model or something like that when it comes to establishing nexus. Now, one other thing that we'll mention here about Nexus before we leave this kind of entirely is that Nexus is going to be different for sales tax purposes versus income tax purposes. It's also going to be different for withholding purposes as well. Companies will often have a withholding requirement for their employees anytime they perform services in a particular state. So if you're sending employees across state lines and you are having them, perform services on a regular basis in a different state, sometimes your withholding requirement is going to be in the state that they're actually performing services in. So watch out for that one as well. Again, especially if you are near a state border. So, maybe New York, New Jersey, Arizona, California, pick your state border. But, a lot of times those areas can be spots where, major cities are. Charlotte, North Carolina comes to mind. Kansas City comes to mind as well. So, so in those instances, be careful about where your withholding requirement is. Nexus is different for sales tax purposes versus income tax purposes. A lot of times there are overlapping concepts. However, they are not exactly the same. So be a little bit careful on that as well. Don't just assume that because we have income tax nexus in a particular state that we also have to pay sales taxes there, and vice versa. It is truly two different buckets that come into play, although there are a lot of overlapping concepts, no doubt about it. Other things that come to mind. So, aside from kind of getting sort of your feet under you from a regulatory perspective and from what I would typically refer to as kind of a compliance perspective, we also want to establish ourselves as, a business and something that is recognizable. And so whenever you're marketing a product for the first time, and I know that there's a lot of books out there and a lot of people that have lots of ideas about marketing, and I'm going to give you some of mine here. And again, if this is helpful to you, take them. If it's not helpful to you, that's cool too. There are a lot of opinions out there about how you should market your products. But for me, I think a lot of times, especially when I'm dealing with clients for the first time, I typically ask them about what makes their product special. If we are putting a new product out there, there's presumably it is to meet a need that was not already in the market to begin with. And so what makes your product special? Even if you're going into an industry that's already well established. So maybe I'm opening up an insurance agency, or maybe I'm opening up a CPA firm, or maybe it's I'm opening up a donut shop, whatever that happens to be. I mean, those are well established industries. What makes us unique? What sort of things, is it that you would want a client to know that's walking in your door for the first time? Maybe they've never heard of you, and they don't really know a whole lot about your particular business. What makes you unique? Why should they spend time and spend their money, buying your product or your service? I think that that's important to think about, because that can help you with kind of your target market, and also with what exactly you are selling. What makes you different? If you can show people that you're different, I think a lot of times you can open up people's eyes. They say, ooh, okay, this is different from what I've seen in other types of industries that, are similar to yours. So what is it that, kind of sets you apart? What makes you different? Where are your potential customers most likely to see your message? I think that's important too. There are different forms of advertising that are out there. TV advertising is still one of the most expensive means, but the fact is that people watch a lot of TV. So, I watch a lot of TV. You probably watch a lot of TV too. And so, where are your potential customers? Is TV advertising going to be the best way in order to sell your product? You get a lot of eyeballs. It's also, probably the most expensive means, or at the very least, one of the more expensive means to actually selling your product. What about something like, maybe Google ads, or email marketing, or, website marketing of some type? If that's the case, again, that is for a particular client. Is your particular client, are they likely to be looking in those areas? What about podcasts? A lot of times, podcasts and YouTube channels and things like that, they can form a large following as a part of that podcast or that YouTube channel. So sometimes the way to do it is to maybe, reach out to, that person, whoever happens to be the YouTube channel that you think is going to be best, where, that is a way to kind of get your product out there and to get your name out there. I think that is, something that is important there. Word of mouth marketing, especially for a lot of service firms, is still a very effective way to market your product or to market your service. No doubt about it. The thing is with word of mouth marketing is that it takes longer. So, a lot of times, and there's always exceptions to the rule, but a lot of times, you got to talk to people about your product a few times before they're actually going to do anything about it. And so word of mouth marketing can be very effective. However, the thing is, though, is that it takes more time. And so, whereas some of these other methods, they may not necessarily take as long. And so you got to figure it out. I mean, just like everything else, there's a cost versus benefit decision that has to be taken into account. I've always been a big fan of trying to figure out what makes your product different, and then also, kind of where exactly are your customers going to be. And so, just kind of think about that. And there is no necessarily kind of one size fits all answer. And I think that that's where, when you're listening to this, that I am probably different from a lot of the books out there that you would probably read about, business development and marketing. Is a lot of times a lot of books on marketing and business development, they kind of tell you that there's one way. I don't personally think that is the case. You may feel differently, and if you do, I'd love to hear about that. But I personally don't think that there's kind of one way, sort of one right way to market. I think that in a lot of cases, you got to figure out what works for you, and there are going to be certain marketing channels that are going to be more effective for you than other marketing channels. Maybe the solution is for you to maybe do Google ads or to maybe engage in email marketing campaigns, or possibly to maybe start your own podcast. So any of those things can be ways to market your product. I also think too that you need to think about kind of how you're comfortable. I'll be the first one to say that that going out and doing kind of word of mouth marketing where you're going to luncheons, and state society functions, and you're attending marketing forums and all that stuff. That is good for some people. For other people, that is just like the last thing that they want to do. And so that's the other thing that I think you got to figure out too, because if you're going to have any success, I think in marketing your product, you got to keep doing it. It's not one of those things where you can just kind of do it once and then all of a sudden it's effective. I think a lot of times, if you're going to really push a marketing channel, it's got to be something that you're comfortable with. It's got to be something that you can do repeatedly, and it's got to be something that you're going to want to do repeatedly as well. Otherwise, I think that you're going to struggle. You're going to have a hard time sort of bringing yourself to actually doing that, kind of over and over again. The other thing that kind of going along with all of these thoughts is that, when you are trying to figure out kind of where your sweet spot is from a marketing perspective and what's going to work for you, whether that's, whatever channel that happens to be, TV advertising or whatever, that we need to keep metrics. And so that's another thing that I'm a pretty big fan of, especially early on, is get your metrics set up. Make sure that you are able to track what exactly is drawing people to your product. And sometimes that can be very simple. I'm not necessarily, saying that we need to come up with these really complex dashboards. If that's your thing, go for it. But a very simple way to figure out kind of where your customers are coming from is just to ask them. Just ask them, how did you hear about us? What sort of things did you go through to actually find us? So how did you come about to our particular site? Did you just do a Google search and we happened to be the one that was closest? What was it that that you saw that was appealing, and what sort of brought you in the door? I think that is a great way, especially early on when money's tight and we don't necessarily have a lot of time to be putting together metrics dashboards. ask people about how they heard about your product. I do think that is a good way to kind of get your feet under you. So after all of that, I know that I just threw a ton at you, but I hope that at least some of these things were helpful. I hope that maybe I maybe at least planted some seeds and maybe gave you some thoughts that you hadn't maybe thought about before or hadn't considered. So I hope that this was helpful. I hope that you found some value in this. Again, a lot of this is just client questions that I've had over time, or questions that I have wrestled with as we've tried to get businesses off the ground. And so I just offer it to the folks out there that if you are getting started and you're just starting a business, first of all, I'm happy for you. I'm excited for you if you're just starting a business, because that is really cool. I think that there is something just really special about building something up from scratch. And I hope that you are experiencing that joy and that excitement as well. And if we can do something to kind of to throw some content out there to kind of help you out along the way, then I hope that we have done that. So I hope that this was helpful to you, and I hope that you continue to listen to the Accountable podcast. So I enjoy making it for you, and I enjoy going through and podcasting and just talking to all of you as I'm out teaching and speaking all over the country. Be sure to check out our YouTube channel and some of the stuff that we got out there, and some of the educational offerings that we have on petersprofessionaleducation.com as well. Some of those may be of interest to you as well. So with that, folks, thank you so much for joining us on Accountable this week, and I look forward to seeing you on another episode of Accountable very, very soon. Thanks so much.